All right, guys. So for this first lecture, we'll focus on basically building the mental frameworks, which, this is all IPDA market efficiency paradigm. All right. This is having a systematic way or stance on the way in which we actually interpret price delivery. All right. So basically, this has to do with the way in which prices and reprices to new levels of liquidity, while at the same time rebalancing ranges that may have been uh, left inefficient. All right. So the very first part of this is ICT price delivery cycle. I'll flow through these and then we'll come back and we'll refine the understanding. So the ICT price delivery cycle, which has four phases, states that the market will always start out in a phase of consolidation, moving to an expansion, and then from expansion we have either a retracement, right, or a reversal. Okay. And the way we know if we're going from expansion to reversal or expansion to retracement, it depends on the overall state of institutional order flow and direction of that current market. All right. So that's ICT's price delivery cycle. Just remember consolidation, expansion, reversal, retracement, or expansion, retracement, reversal. All right. Now, if you were to ask me, if you were to say, hey, Chris, how would you interpret or how would you explain price's delivery on a day-to-day basis? What I tell you is that price will move from buy stops to sell stops, or that could be sell stops to buy stops. All right. Basically, what I mean is we'll go here, we'll create a range, we'll go buy stops, right? Once we take out buy stops, price is seeking sell stops. Now, in in the midst of doing that, what's going to happen is there's going to be some form of displacement, all right? Displacement within this leg of price, all right? Because of that displacement, price is going to want to rebalance that range, right? So I tell you that price moves buy stops to sell stops. In the midst of doing so, it creates imbalances and then it rebalances, right? And then there's fractals all inside of this entire expression. Okay. All right. Now, alongside ICT's price delivery cycle, IPDAX's understanding of price and how price is engineered, right? This is what we'd frame or reference as a high probability pricing sequence. All right. And basically, what that means is that price will engineer liquidity in the form of short term highs. It will neutralize the liquidity, right? Our intermediate, it will distribute. Once it distributes, that's basically that displacement. So here we are, we're engineering. All right. Once we engineer, we're going to neutralize. After neutralizing, we're going to distribute. After distributing, right, there's going to be displacement. We're going to need to rebalance. And then after we rebalance, right, we neutralize, distribute, we're rebalancing, and then we're going to redistribute. All right. This, in our opinion, is a better way of understanding the price delivery cycle because there's fractals within this entire understanding here. All right. So keep that in mind. We'll come back to that as well. Okay. Another mental framework that you guys should understand is that when price is delivering, all right, in a trending market, price will trade stops to imbalance, imbalance to stops. All right. So if you look here, what's happening is this market is moving. All right. And we don't know if we're in a retracement or reversal. However, what we do know is that this little area here is a higher time frame array. All right. So price is moving stops to inefficiency, inefficiency to stops, stops to inefficiency, inefficiency to stops, stops to inefficiency, inefficiency to stops, right? It makes it into the higher time frame array. All right. And once it makes it into that higher time frame array, what we have to understand as traders is that this is going to be an inefficiency, right? So if the market trades stops in inefficiency in a trending environment, all right, so let's just place trending up here, all right, then we have to have an answer for a reversal, all right? So when price trades to that higher time frame array, more times than none, what's going to happen is if you look at this sell side of the curve, price is respecting premium arrays, right? Every single range, if we were to measure every single range, premium and discount, pulls to a premium array, respects the premium array, all right? Well, once we make it into this higher time frame array, okay, which is probably supporting bullish order flow. This lower time frame bearish order flow, which means that premium arrays are respected. When price meets this discount array, all right, our very first sign or shift, right, in structure is us looking at this inefficiency here and seeing if price honors that inefficiency or if it disrespects that inefficiency or negates, right, however you choose to term it. Okay, that's literally our very first sign. That's a key point right there. Okay, RCT mentions, the liquidity, right? These lows, that's market structure 101. But he says market structure 201 is really understanding the inefficiency. And it's not just the inefficiency alone, it's more so of a cause and effect type of scenario, right? This is the cause, higher time frame array. Effect is premium arrays are no longer being respected. All right. Now price seems to be respecting discount arrays. All right. Which flows in line with this higher time frame array. Okay. All right. We can also express that as price moving from internal range liquidity to external range liquidity. All right. So if we have this market here, all right, and we see the market expand here, all right. So we're taking out external range liquidity, all right, and then we reprice back to internal range liquidity, back to external, so on and so forth. All right. And then also, right, price will trade from fair value to discount. So when we're speaking about fair value, we'll learn about what fair value is, fair market value is in another teaching. But if we have this little range of price, right, everything is offered efficient. All right, market is pretty much fair right here. It'll trade from fair value to a discount, from a discount to a premium, right? And this will be a fair valuation point also to a premium, and then from premium to another area of fair value. Okay, we'll speak more about that in a different teaching. For now, I'm just giving you guys those mental frameworks. So let's go back to ICT's price delivery cycle. We'll bring this over here as well. Let's duplicate it. All right. So just keep that in mind up here. All right. So when we're saying that, hey, price is going to engineer, right? Right here, we're engineering liquidity, right? This is that consolidation, or you can compare it to ICT's price delivery cycle, which states that price will go through a phase of consolidation. All right. So we go consolidation here, right? So price is engineering, neutralize, right? We neutralize the liquidity from this short-term high, right? Once we neutralize, price distributes. That's basically consolidation to expansion, right? And then from expansion, we move into a reversal, right? This would be that reversal. Okay, now looking at our interpretation, engineer here, neutralize. So we're engineering here, neutralizing here, distributing here because we've taken the liquidity. Now we're distributing. All right, we create an imbalance. Now we understand where we are within the market phase. All right, so it's time for price to rebalance that range. Also, think about what we spoke about over here. Price trades from stops to imbalance, imbalance to stops. So when you look at this, we've taken out stops here. All right, now we're going to go from stops back to imbalance, imbalance back to stops. When we think about this up here, that's basically price rebalancing the range and then redistributing. All right, that's also ICT's price delivery cycle, which states that price goes into a consolidation. All right, we understand that this move, this expansion, following the expansion, all right, because order flow is bearish, right? We're in a bearish market, premium arrays are being respected. We see that expansion, following that expansion, we understand that right after that expansion, we should go into a reversal profile or reversal phase. All right, so we go reversal here, that creates displacement. All right, and we know based on this fractal, price engineers, right? So we're engineering here, we're neutralizing, right? After we neutralize, we're going to distribute. Okay, now that we've distributed, we've displaced, we've left behind an inefficiency. So now the next phase is to rebalance that range, right? So here's that retracement. All right. Here's that retracement. We make it up into the inefficiency. And now price goes back into that consolidation, right? Little consolidation. We leave the consolidation, we expand. And because order flow, all right, order flow is bearish, we expand here, and following an expansion is where we should see our retracement. All right, I should have color coded these for you guys, but following that expansion, we're going to see that retracement, right? So this little move here is a retracement back into. So this is price moving from fair value to discount to premium, right? Or fair value point or fair valuation point, and then back down into discount. All right, but we understand this is a retracement phase because we're in a bearish market, right? The expansion was lower in line with order flow, so we're just expecting a retracement, all right? And then on a lower time frame, if you were to zoom inside of here, right, you see lower time frame, little consolidated period, right? Maybe short-term highs, or you see engineer, neutralize, right? Distribute, rebalance, and then that creates, price heading down in that direction for that particular range. All right. So these mental frameworks, if you apply these mental frameworks, specifically understanding the high probability pricing sequence, right? If you apply this to all of your understanding, all right, because this one, the market literally points back to this one fractal. Okay. So if you apply that understanding to everything that you do within a market, all right, because when I'm looking at this image here, actually let's go to this one. When I'm looking at this image here, right, there's so many things that I can see. All right, this could be a market maker. This at the top, we could have been coming from here, right? Where then at that point, that makes this a market maker sell program. Okay, this could be the sell side of a curve. We're seeing up close candles support price. All right, I'm seeing multiple dealing ranges within here. All right, so there's so much that you can see. This here, that one fractal, this high probability pricing sequence is what this entire market points back to. All right, so you can understand it in two ways: ICT's price delivery cycle, or just IPDAX's explanation of it, which I think is a little more refined and easier to understand. All right, so we'll take a look at a few examples. It'll be very brief. So if you look here, we have price consolidating. Right, it's that consolidation. Then we expand, running out stops above these short-term highs. All right, once we run out stops above those short-term highs, all right, after running stops above those short-term highs, right, what happens is we have a bit of a feather swing, right, and then we have that reversal, right? We go from reversal to retracement, right, and then that little reversal again, and we're continuing the direction of that market. But what you should really pay attention to here, and then you can also see we engineer, we neutralize. This would be that distribution, and we're rebalancing, and then we're redistributing. All right, but what you should really see here is the fractal nature of that whole delivery. All right, so I say everything in the market literally points back to this one delivery. Because if you look here, once we go consolidation to expansion, reversal, right inside of here, now that we know that, hey, price needs to rebalance that range, well, we go into a little phase of consolidation right here, right? So that's consolidation, expansion, reversal, down to here, retracement, reversal, right? It's all fractal. We could also express this as prices engineering, neutralizing, distributing, rebalancing, and then redistributing right here. All right, let's take a look at another image. Same idea here. Here's price engineering, right? We even have a short-term low here, right? For consolidation, expansion, or we could say engineering neutralize. From expansion, we go into reversal, right? Neutralize, we distribute. Right after that, now we have we've went from sell stops to buy stops. Right? Remember earlier we talked about price moving from sell side liquidity to buy side liquidity. in the midst of doing so, it's going to create imbalances, and then it's going to want to rebalance those imbalances. All right, so right here, now we understand, all right, it's time to rebalance that inefficiency, and then price expands. All right, but think about it. Even if you look here, you take the delivery of these candles. All right, this is, if you just look at the delivery from that candles, at that point we create a high. All right, the delivery within these candles is literally a little consolidation. All right, so we consolidate here, we expand, so we're engineering liquidity, we're neutralizing, distributing, right, and then we're rebalancing again, right? So that fractal continues to show up each and every point within this market. And what you have to do is, once you truly understand the anatomy of a single candle, all right, you can do a whole lot in terms of really framing out price and framing out direction for certain market movements. All right. So that about does it for this very first lecture. We'll move into speaking about liquidity, right? High and low resistance liquidity runs, and then we'll keep putting the pieces together.